Digital cages. Why a 2026 crash would be worse than 1929. In 1929, people could flee to cash and gold, walk into a bank, withdraw savings, sell physical stock certificates, and survive if they acted early. Today, those exits are largely sealed. Retirement accounts like 401k are penalty locked and take days or weeks to process. Banks impose reporting rules, ATM limits, and suspicious activity delays. Funds can suspend redemptions or trade at steep discounts when liquidity evaporates. Regulation and product design deliberately prevent bank runs. But the effect is that in a systemic panic, ordinary savers are trapped while the system protects itself. Modern traps include administrative time locks on withdrawals, legal penalty gates, mutual fund and ETF liquidity breakdowns, fund suspension rules, private equity lockups, and algorithmic market microstructure that can halt true price discovery. Beneath the surface, leverage and speed are far greater than in 1929. Hidden leverage lives in derivatives, CLOs, and private structures with effective 20/50:1 exposure. Trading is dominated by algorithms that can cascade selling in hours. Treasury liquidity has weakened. Market making narrows. Bid-ask spreads widen. Signs of illiquidity. Meanwhile, insiders and sovereign funds have been repositioning defensively, signaling elevated tail risk. Systemic constraints are also material. Central banks have less ammo, shorter rate cuts, bloated balance sheets. Government debt is enormous, and the FDIC insurance fund is small relative to total deposits, limiting conventional crisis responses. Repo market strains in past episodes like March 2020 and SVB's rapid collapse show payment systems and operational frictions can freeze access for days. The result? In a 2026 crash, you're likely to face fast, deep asset losses while withdrawal requests stall or are penalized, turning paper losses into permanent destruction for retail savers. Whereas 1929 survivors could convert to cash, today your wealth can be a shrinking number on a screen with legal and technical barriers to escape. Practical resilient steps include building accessible cash buffers outside penalized retirement wrappers, limiting exposure to illiquid funds and leverage products, diversifying into truly liquid holdings you can access immediately, watching insider and sovereign flows as early warning signals, and preparing contingency payment plans for business payroll and essentials. Accept tax costs now for liquidity rather than being trapped later. Bottom line, the next major crash won't just be about leverage or valuation. It will be about the architecture that traps savers. Act before the gates close. Systems prioritize systemic stability, not your individual right to withdraw.